Investing is one of the most effective ways to grow wealth and secure financial freedom over the long term. However, for beginners, the world of investing can seem complex and intimidating. Terms like stocks, bonds, mutual funds, and dividends often appear daunting, leaving many people unsure of how or where to begin. The key to successful investing lies in understanding the basics and starting with a plan. This essay provides a comprehensive beginner's guide to investing, offering a clear step-by-step approach to help newcomers navigate the world of finance and build their portfolios. 1. Define your investment goals. Before diving into the world of investing, the first step is to clearly define your investment goals. What are you hoping to achieve through investing? Your goals could be short-term, such as saving for a down payment on a house, or long-term, such as building a retirement fund or creating a college savings plan for your children. Clearly defined goals provide a roadmap for your investment strategy and help determine your risk tolerance, time horizon, and asset allocation. For example, if you are investing for retirement, you may have a long-term horizon, which allows you to take on more risk in exchange for potentially higher returns. On the other hand, if your goal is to save for a down payment on a home within the next 5 years, you may prefer lower-risk investments to protect your capital. Understanding your goals will guide your investment decisions and help you choose the right mix of assets to achieve them. 2. Understand your risk tolerance. Risk tolerance refers to your ability and willingness to endure fluctuations in the value of your investments. Different types of investments carry different levels of risk, and it is crucial to understand how much risk you are comfortable taking on. Stocks, for instance, tend to offer higher returns but come with greater volatility. Bonds, on the other hand, are generally more stable but offer lower returns. To assess your risk tolerance, ask yourself how you would feel if your investments dropped in value. If the idea of losing money causes significant stress, you may have a lower risk tolerance and should consider more conservative investments. Conversely, if you are comfortable with short-term fluctuations and can maintain a long-term perspective, you may have a higher risk tolerance and can take on more aggressive investments. Understanding your risk tolerance is essential to creating a balanced portfolio that aligns with your financial comfort zone. 3. Build an emergency fund. Before making any investments, it is important to have a solid financial foundation. This means building an emergency fund that can cover 3 to 6 months' worth of living expenses. An emergency fund serves as a financial safety net in case of unexpected events, such as a job loss, medical expenses, or car repairs. Having this cushion in place allows you to invest with confidence, knowing that your immediate needs are covered. Without an emergency fund, you may be forced to sell investments at a loss during a financial emergency, which could derail your long-term investment goals. Therefore, having an emergency fund in a savings account or a similar liquid and safe asset is a critical first step before you begin investing. 4. Learn the different types of investments. One of the most important steps in beginning your investment journey is to understand the different types of investments available. Each investment type carries its own risks and rewards, and it is essential to know how they fit into your overall investment strategy. Stocks involve purchasing a small ownership stake in a company and offer high returns with higher risk. Bonds are loans made to companies or governments, offering more stability but lower returns. Mutual funds pool money from multiple investors to diversify into a portfolio of stocks, bonds, or other assets, offering reduced risk. Exchange-traded funds, ETFs, are similar to mutual funds but trade like stocks, providing flexibility and lower fees. Real estate involves purchasing property for income or appreciation. Lastly, index funds track a specific market index, offering low fees and broad market exposure. By understanding the various types of investments, you can make informed decisions about which assets best align with your risk tolerance and financial goals. 5. Choose the right investment account. After deciding on the types of investments that suit your goals and risk tolerance, the next step is choosing the right investment account. Different types of accounts offer varying tax advantages, so it is important to understand how they work and how they can help you meet your objectives. Individual retirement accounts, IRAs, are tax advantaged and ideal for long-term retirement savings. 401k plans, often offered by employers, provide tax-deferred growth and, in some cases, employer-matching contributions. Brokerage accounts, on the other hand, do not offer tax advantages but provide flexibility for general investing. Education accounts like 529 plans are excellent for saving for education costs. Choosing the right account can help you minimize taxes and maximize returns over time. So it is important to match the account type with your specific investment goals. 6. Diversify your portfolio. The adage, "Don't put all your eggs in one basket," is particularly relevant when it comes to investing. Diversification involves spreading your investments across different asset classes, such as stocks, bonds and real estate, and sectors to reduce risk. By diversifying, you can protect yourself from significant losses if one investment performs poorly. For example, if you invest all your money in a single company's stock and that company experiences a downturn, your entire portfolio could suffer. However, if your investments are spread across multiple companies, sectors, or asset classes, the impact of one underperforming investment is minimized. Diversification is key to building a resilient portfolio that can weather market fluctuations over time. 7. Start small and stay consistent. Many beginners feel overwhelmed by the amount of money they think they need to start investing. However, you do not need a large sum of money to begin. In fact, many online brokers and robo-advisors allow you to start investing with as little as $100 or even less. The key is to start small and be consistent with your contributions. Consider setting up automatic contributions to your investment accounts so a portion of your income is invested regularly. This strategy, known as dollar cost averaging, involves investing a fixed amount of money at regular intervals, regardless of market conditions. Over time, dollar cost averaging can reduce the impact of market volatility and help you build wealth steadily. 8. Monitor and rebalance your portfolio. Once you have started investing, it is important to monitor your portfolio regularly to ensure it remains aligned with your goals and risk tolerance. Over time, the value of different investments may change, which could shift your portfolio's allocation. For example, if the stock market performs well, your stock allocation may increase, making your portfolio riskier than you intended. Rebalancing involves adjusting your portfolio back to its original asset allocation by buying or selling investments. Regular rebalancing ensures that your portfolio stays aligned with your risk tolerance and financial goals. Many experts recommend reviewing and rebalancing your portfolio at least once or twice a year. Investing is an essential tool for building wealth and achieving financial goals, but it requires a clear understanding of the fundamentals and a disciplined approach. By defining your investment goals, assessing your risk tolerance, building an emergency fund, and learning about the different types of investments, you can begin your journey with confidence. Choosing the right investment account, diversifying your portfolio, and staying consistent with contributions will help you grow your wealth over time. Finally, regular monitoring and rebalancing will keep your portfolio aligned with your goals. Investing may seem intimidating at first, but with patience, knowledge, and discipline, even beginners can succeed in building a secure financial future.